Well, the tax code contains provisions allowing farmers to derive a benefit from exporting agricultural products. And while these rules do require competent legal help to guarantee full advantages, the the derived reward can be rather significant. Roger McEowen with Washburn University School of Law joins us now with some clarification in today's Rural Money segment. And Roger, as always, thanks for taking the time to chat with us today. Now, one incentive I understand is known as the Interest Charged Domestic International Sales Corporation. Give us an overview of that.
Yeah, good to be with you, Janet. That's right. It's known as an IC disc, and basically what that allows a farmer to do is to sell into an export market through this entity known as the IC disc. And basically what you're doing is you're transferring income from yourself to the tax-exempt IC disc by virtue of what are known as export sales commissions. And so what you're doing is avoiding self-employment tax. If the IC disc is created properly, it is a tax-exempt entity from federal income tax, and any dividends that are paid out to the farmer would be qualified dividends that are taxed at a more favorable long-term capital gain rate. So you're also converting, by virtue of doing that, you're converting ordinary income from sales to foreign unrelated parties. And so you get a lower tax rate, you're avoiding self-employment tax, but you got to structure it properly to make sure that it is a tax-exempt entity.
And is there any way to maximize the benefit?
Yeah, there really is, and it comes back to proper formation. And the rules surrounding an IC disc are flexible enough that we can group transactions, we can take multiple transactions, group them together, and really tailor the computational method in those groupings to maximize that tax benefit. But it is incredibly complex. But the key point is that IC disc doesn't pay tax on the export sales because of its tax-exempt status, and you're going to get those qualified dividends. And we can also achieve income deferral by virtue of the way we receive payments. The farmer receives the payments from the IC disc entity itself.
Roger, are there any other rules allowing farmers to derive a tax benefit from exporting these ag products?
Indeed, there is. There is something that's new with the Tax Cuts and Jobs Act that started in 2018, and that's the Foreign-Derived Intangible Income deduction, or the FDII. What that basically, in a nutshell, allows you to do is take a domestic C corporation that sells into foreign markets to claim a deduction for those sales in the amount of 37.5% of the foreign-derived intangible income. So again, very complex in terms of its computation, but that's the second type of tax benefit that is out there for farmers that are selling products into foreign markets.
All right. Well, Roger, as always, thank you very much for your insight today. Roger McEowen, he's with the Washburn University School of Law, joining us on the phone, of course, from Topeka, Kansas. You can go online to washburnlaw.edu for additional information.